Good morning, everybody. Welcome to 2024. We're using, I guess, Microsoft Teams today, and if this goes well, which I think it's going to, we're going to, from this day forward, continue to use Teams so you can actually see us and we can have more interactivity with our presentation. What I want to do today is review what we own. And I'll show you a little bit more about the process that we adhere to and follow each and every day, and how we pay attention to our positions and look for new ideas each and every day. We use multiple levels of software in our day-to-day activity. Y-Charts is one service. It is a quant tool grabbing data from income statements and balance sheets of over 5,000 companies. Again, the universe that we have to invest in is about 5,000 stocks. And what we want is to focus on only the finest stocks that fit our comfort level for an investable position. So we screen the market down from 5,000 to about 550 names, and that we pay very, very close attention to. In the 550, we end up owning about 50 of those names. So 5,000 to 550 to 50 in the portfolio, and then we monitor the other 500 on a day-to-day basis. But I just want to look specifically at what we currently own. Bear with me here. Just bear with me, bear with me. I'm just logging back in here, folks. Just give me a second.
Just as Wolfgang goes through this, these are the charts that he goes through, and I do on a daily and weekly basis. Our holdings plus the opportunities that we see in the market.
So that is not the right list. So here we go. First stock we own is Apple. And by the way, we also gave you a fundamental view of Apple in the Adobe file. And I will touch on that as well. I'll open that up right now. So, for example, this is the Apple stock. This is the price and the volume action on the Apple stock. On the right-hand side, vertical axis is the price of the stock. Horizontal axis is the date. And in between is the volume. Most important thing is the trend and the price. And you can see the different prices on the right-hand side. Those lines, those smooth lines, are moving averages. The blue line is the last 20-day average price of the stock. The red line is the last 50-day average price of the stock, and the 200 is the average 200 days, or that last 200 days worth of the stocks averaged out. So what we want to do is own obviously great businesses with rising sales, good balance sheets, reasonable valuations, growth, and moat and brand and those types of things. And we ultimately want to own only those names of high quality that are actually moving higher. I don't like stocks that trend down. Stocks that trend down, I keep on my short list to blow out, because the name of the game is to hang on to your winners and sell your losers. But at least that's how I play the game. And again, you can play the game many, many different ways. And yes, this is not the game, this is life, and it's your livelihoods and financial futures and financial presence. But I do believe that if you treat life as a game, you actually end up performing better at it. We don't need to be so serious. So I'm not very serious about what I do, but I like to take a lighthearted approach to things as well, just by nature. Anyways, Apple. So as you can see, stock is trending in the right direction, but it's pulled back recently. Stock got as high as, what, 195, currently trading at 181, but holding the 200-day moving average. That really is a very important line in the sand. We trimmed the stock in the last couple of months. Our position is now quite small, which is good. We still have a profit in what we hold, so we continue to hold the stock. Let's stay on Apple for a second, if we may. So that is the stock itself. I open up this, and you have this file here. So I now open up the Adobe package, which gives you Apple's financial condition of the last 10 years. This is an amazing amount of data on this piece of paper. You can print it, you can look at it on your screen. Again, there's the chart going back 10 years. the trend looks decent on the upper left box. And then if you go just below that, or in the middle of the page, you'll see the headlines, the categories of income statement balance sheet that is being looked at, from sales to margins to cash flow to taxes, operating earnings, net margin, net income, tangible book value, earnings per share, PE ratios, price to sales, price to book, enterprise value to EBITDA, and you go down with a lot of data on here. The important thing is, we'll start with the sales. It's one of the most important things in any business, sales. I have a sales background. It's everything. It's a driving force of the economy. If we don't sell more stuff, GDP doesn't rise. If GDP doesn't rise, the market won't rise, and the economy goes into recession. So you want businesses that are selling more stuff each and every year. Apple in 2013 sold $170 billion worth of phones. 10 years later, they expected to sell $397 billion worth of phones. That is an increase of 150% in the last 10 years, or an 8.5% CAGR if you look at the right-hand side of the chart. So far, so good. That's why Apple's done so well. Their income, it's unbelievable. If you go down halfway through this chart, Apple's net income was $37 billion. That means that they made $37 billion in 2013. This year, they are going to make over $100 billion. Incredible. Apple is going to make $100 billion. I'll put that into perspective. Royal Bank is worth what, Jack? $150 billion?
About that, it's Canadian.
Right. So Apple could almost buy a Royal Bank each and every year. That said, how much better can it get? The market is always looking forward. So as great as the math is, the market's has already priced that in and then some. And as you can see, the market is put a bit of pressure on the Apple stock. So fundamentally, it's an excellent business. The trend of it is still intact, but it's received some weakness, and we got to pay attention to it, and we obviously are. Go ahead, Jack.
Yeah, the one thing I would just say, so both of these, the chart and the table that we have shown you so far, they're both derived from the same software, Y-charts. One of the most astonishing things with Apple, if you look at right at the bottom there, the share count, how much cash flow they've used to reduce their share count. And that is the reason why Warren Buffett loves the company. It's a very tax efficient way to reward shareholders.
Yeah, so back in 2013, Apple had 2.5 billion shares outstanding. With all that cash flow, they bought back about 1 billion shares, taking their share count down to 1.5 billion, which means existing shareholders now own a bigger piece of the Apple pie. And Warren Buffett loves that.
Yeah.
The other point that is very, very important on this company, and many companies we look at, and we've built a couple of what's called quant models, which next week we're going to do another webinar with you on our quant models, because it's actually quite interesting. I think you'll be quite intrigued by their current success. But how good a company can manage a dollar, how efficient they are with capital. Do they destroy capital or do they build capital? And if they grab capital from either the debt market, i.e. by borrowing, or through the equity market by issuing stock, when they receive new cash, how efficient are they at putting it to work? And you look at things like return on capital, return on equity. And in Apple's case, their return on invested capital is 56%. And that has doubled since 2013 when it was 23%. So when Apple makes a dollar, they are able to, according to this math, generate a 56% annual return on each new dollar that comes their way. So very powerful business.
The other point that I would make with the charts and the tables, as Wolfgang scrolls through them, you'll see over the long term, the fundamentals will line up with the technicals, meaning if you got good fundamentals, Wolfgang referenced sales, margins, all the important things of a business, relatively small debt. If you have those key fundamentals, you tend to do well. And those are the types of companies that we do try to seek.
So again, staying on Jack's point, again, that's a great point, Jack. Thank you. Look at Apple now. In 2013, it did 170 billion in sales. The stock was trading below $50. It was probably trading at $25. And it had a PE ratio back then of 14. Fast forward 10 years, the PE ratio of the company is now 30. So it is viewed as a more valuable company, twice as valuable. And the stock so sales have doubled, but the share price has gone from about, $25 to $200. So sales doubled, share price up eightfold. Why is that? Well, because of the margin. Again, it becomes very, very accretive due to economies of scale and the likes. Plus, it has become a more reliable, stable company. So therefore, investors are willing to give it a higher PE multiple. So there is no one factor that drives success of a stock. It is a combination of factors, from trend to market appetite, idiosyncrasies, sector favor, etc. It's a lot of moving parts. That's what makes the job so dynamic and so much fun and such a full-time job. Let's go back to our charts. We only have 47 more of these to go, guys. Kidding. I'm going to move quick. But we currently hold 47 positions in our portfolio. We've reduced the positions down from about 70, getting a little more concentrated, but still a good diversification. So our next stock is Autodesk. Just reinitiated position in this company. Not necessarily timely, but also put a small position on. Stock has reversed course in the last couple of days quite significantly. I'm not happy about that. But Autodesk is really a really good play on real estate and on development. It's a software company that is used by architects and engineers, and they have switched their business model from selling boxes of software to doing ongoing web-based cloud software, so software as a service. So they changed their model, and that takes time to kick in. But what I do like about Autodesk is, so that this is the 1 year chart on it. And if you look at the chart itself going back to February, you can say the stock has broken out from its range of about 225 when it managed to get up to this level that I'm circling right now to about 245. So it looked like it wanted to move higher. I like to buy breakouts. Sometimes they can be head fakes, which this one may, not necessarily was. It's down because of market, not because of the stock. That's very important. Selling a stock because there's a problem with the company is smart. Selling a stock just because the broad market is under a bit of turmoil is not necessarily smart, because you end up throwing away good companies on what's called a weak tape. Time horizon matters, as long as you have a time horizon to tolerate, the likes of COVID, the likes of 9/11, and the likes of, a Russian invasion of Ukraine. Things do pass, but bad companies remain bad companies. So that's a very, very important distinguishing factor. Autodesk is a great company. And what do I like about Autodesk the most? So the 1 year chart, not bad. Look at the 10-year chart. Oh my God, it's a Picasso. I'm kidding. But if you see, you're going back to 2015, left-hand side of this chart, stock trending up very nicely right up until 2022. Then it came under some, COVID pressure and rising interest rate pressure primarily. Interest rates go up, real estate goes down, development ceases, and as such, the company comes under pressure. Stocks formed a nice base in the last 2 years, starting to wake up. Previous high was 3.25. Stock's down 33% from its peak. High quality business. Same thing if you want to go into its earnings. We'll flip over to our next fundamental chart. Autodesk. Now again, you're going to see the sales did get probably a little wonky when they switched models, but the company has doubled its sales once again. More so, 2013, 2.3 billion. 12 years later, 5.4 billion. Stock had a great move, but has pulled back. So I think this stock here is giving us a really good opportunity to reload high quality company that's had a nice pullback. PE ratio was 64 versus 47. Sounds expensive, but for recurring revenue with growth, I don't think I think you're actually getting yourself a reasonable investment here. Time will tell. Monitor position accordingly. Next name, Amgen. Biotech company, drug company, making all-time highs. I do like that. This is one of the first stocks I bought myself about 35 years ago. I wish I just held it. I paid $28 for this stock when I was still in radio sales, probably in 1992. So I've been paying attention to this stock, my friends, for 31 years. 31 years of watching the stock. And I should have been doing more doing than watching. How about that? Anyways, great company we own. Healthcare back in favor. Stock breaking out. Obviously, the market likes it. And when the market likes something, I want a little bit of a piece of it. Again, you can go back to the math on the next page. I won't do that with you. Amazon. Anyone hear of this company? Any box on your front door this week? Probably. Stocks pulled back significantly from its peak. It is a fantastic 7, one of the darlings of the last year. We did trim the position, but still have a position in it. Obviously, it's an absolute leader, behemoth. And it certainly makes shopping. Guys out there don't like shopping so much. Boy, oh boy, I get on Amazon, I get myself a French fry cutter in 12 hours, a slingshot to deal with the Wildlife, the wildlife that's chewing at my house, and no, I haven't hurt any animals, just to threaten them.
Make some noise.
Just make a little noise. That's all. Yeah, slingshot ordered on Thanksgiving dinner, and I got it within 24 hours. And it was $15. It was unbelievable. I could have gone to Bass Pro Shop, spent gazillions of gas and parked and wasted my time to get the same thing. So amazing how great Amazon really is. Anyway, we own a bit of it, but I do think it's heavy. Arista Networks owned the stock, traded it, made money, bought it back at a higher level. It is all about internet security and cloud.
It's about cloud and AI for sure.
Yeah.
One of the pure plays.
Next stock, ARC Resource, Canadian oil and gas company. There's the chart. Interesting, as you can see, where the stock was 10 years ago, where it is today. It is one of the best oil and gas stocks on the board. It is about 50-50 gas and oil. I met management years ago, but it needs to be traded. We've lightened up on our oil position. We only have 3 names, C&Q, ARC, and Imperial Oil, all Canadian names. The world consumes 102 million barrels of oil. Yes, the Western world is coming off oil, and Asia is consuming more of it each and every year. A lot more of it. So is Africa. So oil is not going away anytime soon. Boeing, amazing fleets. Those airplanes are worth, I don't know, $80 million each. They're incredible structures that they build. Volatile stock. They had to pull the stock or pull the product after a few crashes. That'll do the trick. Planes crash, stock crashes with it. It doesn't go to zero. Anyways, the market likes it again. We have a position in it. It's an industrial name, so it's not a tech name. It's not a commodity name. It's an industrial stock, of a very, very high quality order. There really are only a couple of players in the space. A lot of R&D in those planes. And anyways,
I'd say when it's in favor, it's one of the highest quality industrial names that you can own. Back when you see the chart in 2019, 2018, darling of the market, everyone loved it. Out of favor now, as Wolfgang said, they've had their issues, but certainly it has a military component too. Where opportunity to buy a high quality company at a reduced valuation.
Yeah, but not without hair on it. And again, if you look at the math on this page I'm showing right now, you can see their sales. 10-year, they're actually down, but it's about forward estimates. So here the market's looking forward. They had the problems, they fixed the problems. Now they got to sell more of these planes at the air show, at least more planes. Yeah. And
one of the issues they had too was they levered up their balance sheet, which you can see on the bottom there, taking on more debt to reduce share count. So,
but the 2024 estimates is what's driving the stock.
Yeah.
Again, if you look at here, the company lost money in 2022. It's estimated to lost just under $5 billion in 2022. That's no small amount of money. But the company is capable, if you go back to the left, of making $10 billion. So when it makes money, it makes money. So some, Jack, and you're really good at this, Jack, paying attention to rate of change and going from bad to less bad. You get rewarded in the market for going from bad to less bad. And
well, that's the way it works. You don't go from really bad to great. It goes bad, less bad, better, good, great, right? And that's just the market cycle.
Very good. So there's our Boeing stock. Again, no slam dunk here, but I do like the action on it, so I want a piece of it. We'll see. We monitor, of course, and if it goes ahead, it gets away, we'll cut it. Bank of America. I like the space a lot. Banks have been dead for a long time. I mentioned this probably last fall. We're going to be building up our bank position. We own JP Morgan. That one we held through thick and thin, and it actually continued to push higher. Highest quality bank on Wall Street. Bank of America, just below it. Good business nonetheless. The number of catalysts for the banks, lower interest rates helps banks. Loan defaults is reduced when the economy remains firm, which it is, and interest rates become softer, easier to pay your loans off. But the real catalyst, or another major catalyst for the big banks, is in the United States. Some of the regional banks had a hissy fit. When was that? Last year or this year, Jack?
Last February.
Last February, and that knocked the market down. Regional banks are losing market share, and these super nationals are gaining market share at the expense of the regionals. So basically, these big banks are going to pick up free new customers because the regional banks basically can't serve them. because their balance sheets have been stretched a little bit. They were getting exposed to technology. They got themselves
Commercial real estate's a big one.
commercial real estate. So regional banks used to be very relevant for local and regional businesses, but as business becomes more global, banks need to be more global. So the big banks actually are going to get bigger. Anything else you can add to that, Jack?
Well, the other big catalyst for the financials and banks in particular is we've had 18 months of an inverted yield curve. So as the Federal Reserve drops interest rates, or it's expected to drop interest rates, you get back to a normal yield curve. That means low or short-term interest rates are lower than long-term interest rates. And that gives the banks an incentive to lend more. And again, it's part of the cycle. So you see a bottoming process, banks starting to wake up ahead of the normalization of the yield curve. We'll see if it goes as the market is predicting and expecting. But for the time being, it looks like we've gone through the trough of the cycle, and banks are early cyclicals, and they're starting to wake up.
Another company that we held through the last few years, but we trimmed, lightened up, and then rebuilt is Brookfield Asset Management. Dynamic company. Bruce Flatt runs it, has a lot of stock in it, probably one of the smartest men in Canada, or business stewards in Canada, shall I say. The company does way too much financial engineering for my comfort level. Part of their shtick, shall I say. Ultimately, information that's out there is reflected in the price of the stock. So you got to be careful. I got to be careful I don't double count information. The market is all knowing, and so that's why I pay a lot of attention to price action and movement and direction, because the market is all knowing. All the information out there is encompassed, both good and bad. So Brookfield Asset Management, as interest rates went up in the last 18 months, the stock pulled back, found a bottom in November of last year, and it looks like it's starting a new trend to previous peak. There's a 10-year chart on Brookfield Asset Management. Now, this is a company, right, that actually was spun out from Brookfield Asset Management, again, financial engineering. It is a pure play on asset management. That's all it does.
It's fee for service. So clients that are looking for private equity and fee for service business, which the market really covets, this gives us direct exposure to that.
Yeah. So, bookings.com, tech stock, works like a charm. Kathleen, my beautiful wife, uses it all the time to plan our trips. She loves it, thinks it's incredible. And it's amazing, we do have to get ideas from our spouses and from our children. Because Peter's smart. Peter Lynch went up on Wall Street. I like Booking an awful lot. Technically, it's working. Fundamentally, it's working. It has growth. It is capital light, shall I say? Clean balance sheet. The world wants to travel. Travel is a growth industry, and pent-up demand for travel does remain. And you don't have to worry about renting out your house. But the other one that we pay attention to, but I'm not as keen on it, is what's the one that rent out your house? Work repair. You guys aren't talking about. Rent out. Airbnb. Sure. Airbnb. That stock is not working as well. That one has two different challenges. This book I really, really like, to make a long story short, and it's making near all-time highs. We have a good position in it. We are up on the trade very, very nicely. On our booking, we're up 30% on that trade. And that to be up 30% on a $3,000 stock, wow, that's a lot of money. Thank you. Next name, Blackstone. Smartest men on Wall Street, private equity. There's a 5-year chart. Here's a 1-year chart. I like this chart. Again, the blue line is a 20-day average price of the stock, so it's very short term. The stock ran up, as you can see, pulled back, almost held that blue line, so that's good. So that's my first line in the sand, early warning the indicator. Second line in the sand would be the red line, which is the 50-day moving average. Third line of the sand is a 200-day, and that's the one where you got to really pay attention. If it breaks that, you could have a trend break. It could be a head fake too, as you saw in November of 23. Eventually, stocks do find a support. Sometimes they can find support right below the 200-day moving average, which again can be a challenge and a head fake, because a lot of people sell it just when it's about to turn. And I've done that as well. It is a very humbling business. Fortunately, I've been wrong a lot in my life, so I'm actually used to being wrong. It's amazing you can bet in this business. You can bet 400 in this business and still make a good living. That's why I'd be wrong 60% of the time and still make a good living. Got to cut your losses and let your winners run. Blackstone, excellent business. Built out our position in it. Citigroup hitting 52-week highs. I'll show you the 10-year chart. That's incredible. Stock is still 35% from its peak. Very volatile stock, as you can see. It's a torquier bank, but again, it is a multinational bank, supranational. It is picking up from some of that regional business. Company had a dilute back in the financial crises. It was a real dog coming out of the financial crisis, but survived. But again, it looks good. If the banks work, this will actually work a little better. It does have a little more beta to the upside. And again, we bought a small position in Citi, a small position in Bank of America. We had a good position in JP Morgan. If these stocks go higher, I will add to them. It's a small position. If it works, I'll add to it. If it doesn't work, then I'll cut it. So it's a means of managing risk, and that's very, very important to us. Next name, Cadence Design. It is a software company to help companies produce semiconductors. That is, again, one unbelievably smooth-looking chart. That's incredible. That is a Picasso. That usually is a kiss of death when I say something like that. Here's a 1-year chart. Nice trend. It broke the 20-day moving average, broke the 50-day moving average, so came under some pressure, but it's still well above the 200-day. As you can see, the trend of the stock, if I ask a child under the age of 5, put an arrow on the stock up or down, I think most would agree up. Very, very good. I love the semi business. It's got to be onshore. This whole supply chain talk, deglobalization. Semis are everywhere. They're omnipresent. So to build semis, you need software to help design the equipment that makes the semis. That's what this company does. Excellent business. There's an oil stock for you. Canadian Natural Resources. Is that the biggest now in Canada?
It's either that or Suncor.
Yeah.
I think it is.
So this is oil sands and conventional oil. It's one of the biggest in the world. Fortunately, it's on the Toronto Stock Exchange, so we can actually own a very high quality business. This is one. I'll show you a 10-year chart on it. Near 10-year all-time high. That's interesting. So the market likes it. It's a high quality business. I think it's producing. The world consumes 100 to 102 million barrels a day. I think it's producing is it close to a million barrels a day?
I was saying, if you look at that,
but that's a lot. Sorry, but it's huge. It's almost 1% of the world supply of this company. I think maybe 800,000 barrels. It's a lot. Anyways, go ahead, Jack.
I was say it's low cost production for sure in Canada, friendly jurisdiction. And if you look at that fundamental table that we attached as well, you don't have to go through here, but if you look at it, you're going to see it is a cash flow machine because it's able to produce at low cost and a long reserve life.
Stay with me on that. Let's stick with Jack's. If we can find it here.
I think you're too far.
Which is, just bear with me. It should be in the C's. Oh, it should be Canadian Natural Resources. Must be in here. It is. Stay with me, folks. There you go. There you go. All right, Canadian Natural Resources. So here's the math. There's the chart. You see the chart. Now the chart's not as clean as ours. Their sales in 2013 were 17 billion. Estimated 2024, 37 billion. Right? That's what we like. Shares outstanding, flat. So they have not bought back stock. They didn't issue stock. That's fine. Now let's look at the very bottom, friends. Return on assets, return on equity, return on invested capital. This company knows how to make money with a dollar of capital. 14% return on assets, 28% return on equity, 21% return on invested capital. Wow, that's unbelievable. And again, so these companies are capital intensive, and once they build their upgraders and refineries and all the stuff they make to extract oil from Mother Earth, once that stuff's built, now he's got to maintain it and let it run and spit out money. This company is making money. If you look at net income in the top middle of the math, the company is expected to make $8.2 billion this year. So there's another company you own. Very high quality business. All right, next. Elf Beauty. This is a teen idea. I've got this idea actually from my daughter. It's makeup for 12 to 24-year-olds. The beauty category is in, and Elf Beauty has a price advantage. Their product is very inexpensive, like $8, $9. Teens have a lot of money, and they like to spend it. Obviously, teen girls like to put on makeup. And I'm sure LGBTQT also wants to put on some makeup. Something like that. So Elf Beauty is on trend. Company makes money. We have actually an analyst at Canaccord that covers the company. She's keen on the category as we are. It's an idea. We're up on the trade. We monitor. It's just a unique Peter Lynch idea, shall I say. Eaton Corp, they're involved in the electrification of the world. You actually see their trucks every now and then in Toronto. Electrification, EV, online. I just did a radio hit this morning with Kelowna, BC. I do one every Friday. And the host there said, hey, Wolf, in the last month, we had to import, I think he said 45 megawatts or million megawatts of 50 million or $60 million. Kelowna, BC had to import in terms of electricity because the water flow is lower. And they're expecting to be a very dry summer because they're not getting snow, less mountain runoff, less water in the rivers. So the world needs power. And every now and then, hydro doesn't work due to weather conditions. Anyways, Eaton is very much involved in wiring up the world on trend. Different way to play Tesla is another way to put it. Fortis is a utility, pretty boring. Utility companies are boring. The one we really like, Fortis is very, very good, but the one we really like is Hydro. We own that as well. You'll see it. Alphabet, Google, we trimmed the position, still have a small weight in it. We have a small weight in Amazon, small Apple, small Google, small Meta, big Microsoft. And again, I say small, want to be there, but those names were the darling of the last 2 years. Of the last year. They were dead the previous year and very strong for 3 years prior. Every dog has its day. Stocks need to pause. Money does rotate. We're seeing rotation. So we're lighter, but still there. Google is a great business, obviously. And it's a name that's actually based by IPO at the sort of the start of my career here. It's 22 years on the board. Goldman Sachs, out of favor, back in favor. U.S. Financial, again, very, very smart people. 10-year chart, peak was 4.25, stocks 382. Not the cleanest trending chart. Get at the right point, you can make money. We just bought again a 1% position. We're probably up on the trade. 8 times earnings. Wall Street always gets a piece of it, so to speak. You're dealing with the best there.
Without question, a leader in the category. And as interest rates stabilize and they're expected to go lower, you reset the capital cycle. People raise money, do IPOs. We're not there yet, but
we're actually at the bottom of the
market is getting
the capital cycle, which means companies coming to market to raise money has been so dry. There is no IPOs, no financings, and at some point, balance sheets get stretched and they need to do deals, either debt or equity. And when interest rates are high, they're not raising debt. And when markets are under pressure, they try not to raise equity. They want to borrow when money's cheaper and raise equity when the stock is high. Bad companies tend to do the opposite. But when they raise money, debt or equity, they have to go to the big banks to help them do it. Goldman Sachs, of course, is a firm that does just that, and they do it very, very well. So when the cycle turns back up, boy, they get a good piece of it. Hydro One, this is a beauty. Spun out from the government. Again, that too is Peter Lynch. You buy what the Crown is selling. We didn't buy it coming out of the IPO. Should have, didn't, monitored it. I'll show you a 10-year chart on Hydro. And I'll tell you the interesting, again, see on the left side, that is when it IPO'd. I'm sure that's the IPO, it is.
Yes.
It IPO'd right on the left. It went up, coming out of IPO, then went down and made a new low. And that's my point. You usually get a chance at lower prices. I didn't buy the low, far from it. Made a low once, and then it came back. That would have been COVID. People aren't going to stay home. The industry shut down. That's why Hydro shut down, because the industry shut down. But that's a very, very clean chart. As clean as stock charts can get. Even a clean stock chart is volatile to some degree. But this is darn clean. Every year, mark my words, I will make any one of you a bet, and if I'm wrong, I'll buy you the finest lunch on Bay Street. If I'm right, don't worry about it. But if I'm wrong, and my bet is as follows. Next 10 years, every single year, Hydro One will raise your power prices. Who's going to take that bet with me? No takers, eh? I don't blame you. So own Hydro, though. You're going to pass it on. They pay a dividend. It's boring, and it has some growth. And guess what? They're in the business of electrification. What's one of the themes I've been talking about for this decade? Electrification. So on trend. Hershey. Oh, yeah. This was fun. So we bought the stock. I'm fully guilty. Somewhere, I don't know where we bought it. Bought it somewhere over here. It didn't work. Cut the loss. Watched it go a lot lower. Wait for a turn. Again, what does Hershey do? They make chocolate. And what hurt Hershey? The company had a great run. The economy was going to slow down. Hershey chocolate is an indulgent. And more importantly, and again, Jack was all over this, is those weight loss drugs. If you're on a weight loss campaign, well, you're not eating as much. And that affected anything to do with food. Is remarkable. But Hershey is, great brands inside the Hershey company. If you go to the website, you'll see all the different brands underneath it. They do a very, very good job. Warren Buffett has made a lot of money with his darling See's candy. I don't know what See's candy makes, but they make candy other than that. And do you ever eat See's candy? Yeah. Oh, the chocolate?
Yeah.
Is it good? Probably not.
No, it's good.
Is it good? Okay. Jack likes See's candies. Anyways, Hershey just bought the stock. This year is amazing. You can just see how the trend went from 270 all the way down to 185. It finds a bottom and begins to turn back up. I love buying turns because the upside is amazing. Like first resistance is that 200-day moving average, which is 2.25. From 190 to 2.25, that's $35. That's 15%, and I think that can come in if this thing gets going again pretty quick. High quality business. It's a consumer staple. Staples are back in favor. So I like to buy turns on an awful lot. So I like breakouts. I like turns. The bond market. This has been fun. We bought the turn, my good friends. We knew didn't know. We assumed and continue to assume since last fall that the interest rate hike cycle is over, and at some point they're going to stop. They're going to start lowering interest rates. So when the cycle is over, that means that the bad news is getting less bad, and the world was running to GICs. And again, GICs are bought by retail. Whenever retail buys something in large amounts, they tend to be wrong. They buy too much pot at the wrong time. They buy too much technology, like Nortel, at the wrong time. They just get it wrong over and over and over again. There's $700 billion sitting in GICs right now, and Jack and I said to ourselves, this is wrong, just based on history. What is the right play on the debt market? The right play is, GICs are guaranteed investment certificates. That's nice. Your money is guaranteed, but your money is locked up, and you're restricted as to how much you buy in most GICs to 100 grand. There are other ones out there that we actually have access to that are provincially backed by various provinces in Canada, BC and Alberta, to name two, where you can actually go unlimited on some or $1 million on others. But your money's locked up. And the second risk is reinvestment risk. Interest rates are going to come back down. So when those GICs do mature, anyone who owns them is going to be accepting a lower rate. The bond market is liquid. GICs are not. The bond market, U.S. bond market, are AAA rated securities, or AAA. I think it's AA plus or AAA minus, whatever. They got a debt, but it's still AAA.
The U.S. is not going to default on their debt.
Not going to default on their debt. It is the most liquid market in the world. It is the most efficient market in the world. It is where big money goes, not retail, but governments and institutions and pension funds. When they want to put their money safe, it goes into T-bills. And the beauty of T-bills is they're always resetting their price, their value. If interest rates go down, the GIC you own is worth more money, but you will never get more money for it. If you hold a 5% GIC and interest rates tomorrow go to 1%, that GIC is worth a lot of money. Guess what? You won't get that lot of money. If you want to get a lot of money, you got to trade the bond market where you can actually exit that trade. And that's exactly what we did with buying the bond market. We bought the U.S. Treasury market, 7 to 10 year part of the curve, 20 plus part of the curve. In 45 days, that trade is up north of 10%. And we just had a recent pullback in it. So even after the most recent pullback, we were up significantly on it. The TLT is the other one. Actually, the TLT that we own is up 13% in 45 days. That 13%, by the way, is a capital gain. So to get it, that means half that is tax-free. A GIC is fully taxable. So a 12% capital gain has an interest equivalency of almost 20%. That's like holding a GIC for 4 years. We did that in 45 days. I'm going to say that's the best trade of my career. Hard to believe, but it's because it was such a safe trade. In other words, we bought a very safe instrument and made an amazing return. Question is when I sell that, that's my next part. Buying, but we bought it really well. That'll make myself easier, but I'm not off the trade yet. I do think we hold it until we actually see a first rate cut, and then the cliche buy on rumors, sell on news will occur. Give me a rate cut, I'll sell that, and we'll see. So we continue to monitor, as we do every day for you. We monitor your positions every single day. Next trade, another oil stock, Imperial Oil. Great high quality oil producer in Canada. This company does not raise money. They got a clean balance sheet, and they just do great clean production. There's a 10-year chart on it. So, not without challenges, but it's certainly not an excessively volatile stock. Don't forget over here, this was the buy of the lifetime. And we did buy oil for you, my friends, during COVID, just not enough. But we made some good money buying oil for you in COVID when oil went negative and was basically trading at free. Yes, oil went negative. Now it's $80 a barrel. Crazy things happen. Gardner IT, it is a consulting firm for IT, allows companies to have access to, I think it's about 800 IT specialists globally, but you don't have to have them on as full-time staff. You have access to a pool of 800 people for a subscription price. IT is basically like a must-buy bolt-on in any IT department for Fortune 500 plus companies. Great, high-quality business.
It leverages the AI trade as well. So as people are looking or thinking about how can I take advantage or look for opportunities within artificial intelligence, if people are going to transition and businesses are going to transition, these are the types of services that they're going to be using. And you can see it in the chart there, how it's had a good move in the last month or so anyways, but the long-term chart is very favorable as well.
And the math is favorable along with it. Here's one for you, J&J, talcum powder. Talcum powder caused them some issues. High quality business. But again, if you bought the stock in 2018, you're barely up on the trade. So we bought the turn, I think. Pharma, healthcare back in favor right now. There is a 1-year chart on Johnson & Johnson. Finally got above the 200-day moving average, above the 15, above the 20-day moving average. Perhaps a trend change is in order. Base at 147. Bit of confirmation up here at 160. Cheap stock fundamentally, pays a dividend. It's a consumer staple name, and staples were out of favor. They're getting a bit of a bid right now. So we have a small place in Johnson & Johnson and Amgen. Here's JP Morgan. We've held this stock for you for years. Stock is making new highs. In fact, it's making all-time highs. Pretty close for with its previous high. I love all-time highs because everyone's a winner once you get through it. So JP Morgan, high quality business. We got a bit of a market weight position in it, shall I say. This one's beautiful, Lennox Heating and Air. This is a green idea. Energy is becoming more efficient, less carbon, more recycling. You see all the posters and marketing in Toronto, how they're using lake water to heat and cool the city, and they want to be carbon neutral by 2040. The city of Toronto wants to be carbon neutral by 2040. I say good luck on that.
Well, there's government incentives behind that too, especially with the more efficient heat pumps that we're seeing. And we have friends in the HVAC business that are talking about it and saying, the government is, and tax dollars are subsidizing green revolution, and Lennox is certainly a play on that.
So if you look at the chart, stock is basically making near all-time highs. Market likes it. So yeah. I'm going to listen to the market. Lindeen, this is an industrial gas company, very unique name. It is a play on a number of different things. It's got an EV play to it. I think it's got a semiconductor play to it. It's got an AI play to it because they use these gases for a whole lot of funky purposes. And Lindeen is certainly on trend. Lam is a semiconductor company. They make equipment to make semiconductors. Again, we talked about the onshoring. Great name, bit of a pullback, still holding trend. The last, as I said, 4 or 5 days in the market, you can see it right here. There's Jane. There is.
The gap is in.
No, what date is that? What date is that? Bear with me here. Okay, just give me 1 second, friends. Yeah, there's December. So that was the end of the year right there. So that's Tuesday, Wednesday, Thursday. Yeah, Thursday, Wednesday, Tuesday, right there. So this is the last 3 days. This is the start of this year. We're off to a bit of a weak start this year. That said, as I speak to you so far, right now, market's doing very, very well. Our growth account, as I speak to you, because we watch this live, I can show you something really cool, guys. Just drag something over. So we were able to, I don't know a single broker on the street who does this, we're able to watch our portfolios live. There's their Canadian stocks, there's our US stocks, that's my portfolio, which means that's your portfolio, same thing. There's the growth portfolio. There's the balanced portfolio, there's a conservative portfolio in real time. And there's the positions that we own in real time. and how they're doing, et cetera, et cetera. So it's great. We have a very, very keen eye on your money and our money. Next thing, MasterCard. Digital transactions, totally on trend. There's a 10-year chart on MasterCard. I asked a kid, which way is this thing going? And that's the answer I would invest in. It's very, very clean. There's your Facebook. There's a 10-year chart trying to take out its previous high. There's a 1-year chart, beautiful. 3-year chart trying to take out this high over here. I think is going to do it. We trimmed the position back again because it was last year's darting. Still got a trade on of about a 1.5-2% weighting. Great name is going higher, I think. Again, Facebook and Instagram. Plus, what else? Anything else?
What's that?
Facebook, Instagram for that. Is anything else at the hill? That's the biggest thing.
And WhatsApp as well.
WhatsApp, there you go.
Go back to that chart just 1 second.
Sure.
The other point that I would reference here, Wolfgang's talked about it a couple times, breakouts. Meta, go back to the other. Yeah, so I was just going to say, you can see gap ups here, right?
Yeah.
Within the trend. So gaps up early in the year last year, and then the trend continued, and another gap up. So good things were happening with Meta. Obviously, you got hurt with higher interest rates and lower valuations. People thought it was off trend, but you can see the market gives you cues or clues. And last year, at the beginning of the year, we were buying companies that were gapping up and showing good shorter term trends. So we were buying the gaps last year.
You know, it's very, again, technical analysis. We're trying to teach you something here, folks. Gap downs, here's one right here. So the stock goes up, news comes out, stock pukes, gap down. Gap downs are terrible.
Okay, retail tends to buy those. They say, oh, the stock was trading at 330. Now it's trading at 225.
Good point.
Must be a good opportunity.
No,
something's changed.
Something's changed. So there's a gap down, negative sign. There's another gap down, negative sign. Then all of a sudden you got yourself a base forming, a bottom forming. The real smart people buying right here, and then news comes up, bang, gap up. That's a positive. Now you got a net positive. That needs to be purchased. Again, you'll be early a couple of days. You come down to trend line. Shoot, I just bought you stuff. Don't do that. But gap up tends to come down a little bit. That's, again, my job to do. It's not yours, but it's explained to you. And now you see the stock moving higher. Then more good news. Bang, gap up. A little retreat, on trend. Another gap up. Pulls back a little bit, on trend. So I like this stock a lot.
So the other point that I would make is Wolfgang said, we have a position in Bank of America. We have a position in Citigroup. If they continue to go higher, I will buy more. May have confused some people. That's a good example of what we did last year. Bought Meta, continued to go higher, added to the position.
We kept adding to the position. You are correct, Jack. And then we recently stole some just to.
So it's a little counterintuitive.
Very counterintuitive. So here's another name, 3M. Bottoming, turning the corner. I like turns. Look at 3M. If you go to the website when you're bored, just look at how many different products they make. They got themselves into trouble. They had some earphones, earplugs, headsets that were sold to the military and soldiers in combat or wherever weren't getting proper protection and had damage. They claimed to the ear. Class action lawsuit. They're going to lose it. They're going to have to settle it and pay billions of dollars. The good news is settlement is now imminent, and both sides are likely to agree. Market can now move on, or the big can now move on with its business. But look at this stock, OMG. Go on the website, you'll see the product. Company is still in business, doing just fine. We can look at the math on it and see what the estimates are going forward. I know they're fine. But this was a $260 stock that is $100 now. So it is down 60%. So when you buy great brands with moats, when they get into trouble and are on sale, you get a chance, but you got to sort of wait. And so I've been watching this name for years, and I mean years. Just recently purchased it for you right around here. And I was watching, getting a little excited. And I was, wait. The analysts don't like it. And that's, again, so I'm leaning against the analysts here. They're not on side with this name yet. I think they will be, but they want more assurances that it's all clear skies, green light. But the market is ahead of them. And so the market is all knowing. And often analysts get behind the curve. I like to have the analysts on side with me. This gives me more comfort in my decision-making process, but I have to be willing to sort of lean against them or be ahead of them every now and then. And the analysts are just analyzing math. They're not looking at trends, and they're not actually managing money. They take 15 names, they follow them, and do their analysis on them. Whether or not the market agrees with them is a different kettle of fish. But they usually end up following trend when trends run for a period of time. Anyway, 3M, I do like it. I think the news has gotten less bad, as Jack spoke about. And at some point, the news will actually get better. Microsoft. This one, my psychic told me to hang on to it. I'm not kidding, but I am kidding. But no, actually, I had a psychic on my radio show. She was amazing. And Microsoft is totally on trend. That's one of the names we did not trim back. We still got probably a 3% weighting in it. So there's a trend on that in there. We got about 10 minutes left. It's a 1-hour webinar, so I got to move quicker here. ServiceNow, workflow software on trend, small position. Nutrient, I'm tempted to sell this one, not working for me, but I'm still hanging on to it. It's got a tight $74 stock. You know, if it breaks 70, I'll be out for sure. I may sell it today, may not. It's trying to form a base. I don't see a base coming in yet. Trying to. Good, it's up now, up 1%. I almost sold this morning, 1% lower. Thank God I didn't sell it, but it's on my short list. It's a deep value play. It's an ag stock, largest in the world. And again, I can own great business, but if the market doesn't care, it doesn't care. And I want wind at my back, which means I want the market ideally at my back, give me some wind and owning great businesses that the market appreciates. So there's a lot of factors. Sorry, go ahead, Jack.
I say, looking at that chart, the chart does look terrible. We did buy weakness on that chart, so we didn't buy it up at the 112 level. We actually traded. I think we sold it probably 120, 130 previously. So anyways, my point is we bought weakness on that. We're still holding it for the time being. It is a small loss at this point.
Very small.
But it's, I'm going to say 6-7% loss. Very manageable, and it is a high-quality business. If it doesn't work, we will move on and cut it. But for the time being, as Wolfgang said, we're holding the position, seeing if he can get some relative strength.
We are down 6.09% on that live quote to you, friends. There's a 10-year chart on Nutrient. Back in January of 2022, it was 150. We sold it back then. We probably got 124 as Jack's. I don't know exactly what it was. Sold it, it pulled back. I waited, we bought it. And again, what did we pay for the stock? We paid $80 for it. It's 74. So we're not an awful lot on it. We're getting paid almost a 4% dividend yield. But again, I want to own stuff going up, not down. So I monitor it nonetheless. NVIDIA, semiconductor stock, AI stock, darling of last year. We traded it, made a lot of money. I bought a small position back just to be at the party. It's holding in this year. I wasn't sure if it's going to have carryover from last year. So other stocks have broken down this year. The stock hasn't gone up, but it hasn't gone down. So it's showing relative strength. So I'm going to hold a small position because obviously AI, according to my psychic and myself and Jack, AI obviously is a thematic trade that has a lot of legs to it. Palo Alto Networks, internet security, cybersecurity, very, very important. Hack after hack. It's an amazing industry because that is where the new war is going to be fought. So Palo Alto Networks, a leader in the space. Ralph Lauren, luxury brands. We made a lot of money for you trading Ferrari last year, and we also traded Louis Vuitton, and we took a small loss in Tapestry. There's still the rich still have money. Much of the luxury trade, much of the growth around the luxury trade was to come out of China. China has been slower to reset. At some point, China will reset and they will consume. But nonetheless, beyond China, the Middle East, there's a lot of money in the Middle East. There is, emerging markets seeing the rise in the middle class. And when people have more money, they want to show off their wealth. So luxury brands is amazing. I saw yesterday, I don't know, for those of you who have Wolf on Bay Street wallets, if you don't have one, you can call me, I'll give you one. My little wallet, my Wolf on Bay Street wallet, costs probably about $50. I saw someone with a wallet half that size. It was like a business card holder, and it was a Prada. And I said, oh my God, stop the buses. How much did you pay for that? $150. Cost to produce that Prada wallet, $1. Talk about gross margins. Oh my God. It's incredible. Luxury brands is a weird space. And if you want to get even weirder, watch The Value of Everything, I think it's called. The Price of Everything on Netflix. It's about the art market. It's absolutely fascinating because art is an asset class. And, Jack and I pay attention to asset classes. And when the economy is rip-roaring and everyone's making stupid money, it's those asset classes, yachts and arts and wine, that go parabolic. And as soon as the market shuts down, the economy shuts down, that stuff goes cold. So it is actually fascinating to watch as alternative indicators. Sotheby's is another stock to watch for those types of clues. As is luxury brands. Luxury brands remain on trend. So if luxury brands are working, I don't see a big recession. Certainly not for the well-to-do. Royal Bank of Canada, totally again another Canadian bank out of favor for a long time. We held a small position in it. Just built our position at $1.25 in the portfolio a couple of weeks ago. Stock's now at 134. So moving our direction again. Lower interest rates help. Soft landing in the economy helps. Obviously, oligopoly helps. Yeah, it's good business, obviously. Snowflake, again, it's a marketing tool.
It's cloud optimization software is really what it is. And I would say even Warren Buffett was pretty excited about the IPO on that one when it first came out. So very expensive stock. We have a small position in it, but you can see the long-term chart going back to, well, it's only 2020 with COVID mania, I guess, there.
Yeah, so this Snowflake would have IPO'd right around here. In fact, there it is. There's your IPO on the stock, my good friends. You have purchased Snowflake below IPO price. That's something. We own the stock, took a loss on it. It went a lot lower. I think it went a lot lower. Maybe it came back. Anyways, it looks better now. High quality brand. Give them time, you may get a chance. So we got a small position in it. We will see. Again, I monitor these positions. You don't know till you try. AT&T. Oh my God, this is a fundamentally driven business, both good and bad. AT&T, you know what it does? There's two carriers in the United States that are of size, AT&T and Verizon. Both companies have 100 million customers. To refresh your own memory, Canada has a population of 38 million. So 3 Canadian populations are the customers of each of these carriers, AT&T and Verizon. These stocks are beyond cheap, and they make gobbles of money, oodles of money, oodles and gobbles, lots of it. They make tons of money, and I mean lots, and they pay big fat dividends. But they have a lot of debt, and they have a lot of competition, and price competition does not do anyone any good. Anyway, great companies, cheaper than chips, and guess what? We bought the turn. We bought these names right here, give or take. I was watching them forever. Say, I got to come back to these names at some point. They are play on lower interest rates because the debt levels, and with bonds yielding 4 or 5%, a 7% dividend is not nearly as attractive as it once was. But interest rates go down, that dividend that it pays is very attractive. AT&T's dividend is 6.3%. Verizon's dividend is 6.6%. The company's traded at an 8 PE multiple, which means the earnings yield is 15. So these companies here's the basic math. If the dividend is $2.66, that company is making $5 a share. It's giving you $2.66. It keeps the other $2.40, whatever, to buy back stock and to build the 5G network. So amazing. These companies are trading at near 10 and 20-year lows. Like, look at that. Wow. Stock was 30. It's in half of where it was. So obviously that means great potential to as long as the turn is correct. I think we bought it well. TD Bank, like Royal Bank, well off its peak, deep value, out of favor for a period of time, bit of a turn in place. We bought the turn. We bought this. So I'm very happy with that. So I like breakouts, I like turns. Is that no man's land that's tricky. There's the other side, the bond trade. Again, bought this bond in around here, 45 to 60 days, a 12% return plus interest plus capital gain trade. Very, very nice. Uber, I like Uber. I like Uber a lot. It's got good legs to it. 10-year chart, look at this. Nice, challenging his previous peak. I think it's going to go through it. So it's a fabulous tech stock, capital light. Jack, you Uber your kids around yet, Jack? Jack is
we did on New Year's.
You did, right?
But you know what?
No, your kids on there by themselves?
Oh, no.
You will. Yeah, you watch. You will soon.
Oh, yeah, for sure.
My 16-year-old daughter now will take Ubers by herself. Now she was willing to do it at 10. Mom and dad weren't. But yeah, we even let our kids Uber around.
But without question, a leader in the shared economy, and I think it trades at 2.5, 3 times sales. So it's really not that expensive for a leader in its space.
Yeah, we're running out of time here. A couple of the stocks. There's your Verizon. We showed that to you. Same thing. Look at you, cheaper in chips, half price. Who doesn't like buying good business on half price? I do. But you're getting the stock here at a 10-year low. There's Xylo. This is internet for real estate. I really like this company because real estate has not been disrupted yet. Every other business is getting disrupted, not the real estate market. This is an amazing play on real estate. We have a list of 50 real estate stocks. from a relative strength point of view, this stock ranks number 1. So we don't need to buy real estate to play real estate. Any kind of searches on real estate, Zillow is the number 1 hit site. You can get a mortgage through Zillow. You can buy a house through Zillow. Yeah, all kinds. It's a great business, and it's on sale. Last stock to look at, Zscaler Internet Security. Anyways, I think we are out of time. Was there a limit on this?
I believe so.
Yeah. So we're going to send this package out to you. I hope you enjoyed it. I hope you found it useful. And wow, that was weird. That was my stereo. Anyways, we hope you found it useful. We'll send you out a package that you can review at your leisure, pass on to your friends. And we're going to do another call next week. We have a lot more to talk about. We have a few new offerings that we think will be of interest to you. I'm going to call it man versus machine, and machine may beat man. And well, I want to be the man, but I think the machine's better. Just a little teaser for you. So next Friday, we'll do another conference call with you. Any questions, anytime you want to come out and have lunch, come out and see us. Anytime, we're always here for you. Otherwise, we'll continue to monitor your money and do our best to build wealth for you. Have a great weekend, and thanks again.